Is there a crisis building in the repo markets? SOFR spreads are suddenly the talk of the town, but what is the latest update on the worsening liquidity conditions in the overnight repo market? So here we're looking at SOFR minus the Fed funds, a 10-day moving average, and we can see it is now 10 basis points. This is the highest level going all the way back to 2019 when, of course, we had the repo rate crisis. Now, if you've been following the channel, we warned about this liquidity shortage back in early August. So you have been very ahead of the curve. Everyone on FinTwit suddenly talking about this. We're going to give an update in this video. As we can see, the 10-day moving average is now at an all-time high going all the way back to 2019. And again, remember what this fundamentally represents is a shortage of dollar liquidity in the overnight lending markets. Now here we are looking at two of them. The SOFR volume, $3 trillion per day, is loaned back and forth between financial institutions versus Fed funds, only 93 billion. So SOFR, the secured overnight funding market, is far, far, far larger than the unsecured interbank lending market of Fed funds. Now, here we're looking at the reverse repo minus the standing repo. Remember what the reverse repo is a Fed facility when there is an excess of dollar liquidity. The standing repo, on the other hand, is the exact opposite. That is a facility where the Fed gives you cash. You're the bank, you need cash. You go to the Fed, provide them collateral, and they give you cash. And what the white line is looking at is the difference between those two. And of course, they printed a lot of money in 2020, 2021. In fact, at the peak here, the reverse repo had $2.5 trillion. And again, you can think of the reverse repo as a storage tank for excess dollar liquidity. Well, that storage tank has been drained. Of course, the TGA, the Treasury General account, the government's checking account, that has been being built up, and that money must be removed from the financial system. We've had some very, very large auctions, treasury bond auctions, bill auctions, very short-term bill auctions. And of course, the reverse repo has been being drawn down in addition to the large fiscal deficit that the government continues to run. This is all leading to a shortage of dollar liquidity in the financial system. And this has actually gone negative a couple times this week. TradingView only shows a Wednesday level for the standing repo, but this is starting to go negative again, just like it did back in September of 2019 when there was a severe shortage of dollar liquidity in the repo markets. And we got SOFR about 900 basis points on an intraday basis above Fed funds. And here we can see that this has been moving basically vertical over the past couple weeks. Now, here's the daily chart looking at Fed funds minus reverse repo, again, showing an interest rate spread between the two of them. And then in blue, we're looking at, again, SOFR minus that reverse repo interest rate. We were looking before, I know this might be confusing, the reverse repo, here we're looking at the level in the actual facility. And when we're looking here, we're looking at the interest rate that is awarded in that facility. And what we can see, of course, a lot of intraday volatility with these spreads, especially with SOFR. But we can see two dynamics, both in the Fed funds and in the secured overnight funding markets. There is a shortage, a building coming shortage of dollar liquidity in the system. Therefore, the interest rate, the few firms that actually do have cash on Wall Street, they get to charge a higher interest rate, a higher price on lending that money out. And that is what we're looking at. I highlighted in red every single time that the standing repo has been tapped here straight from the Fed's website. We can see it is quite rare for this standing repo facility to get tapped and is getting tapped to an increasing degree over the past month or couple weeks or so. And we can see that again with the red lines. It is becoming more and more frequent for this standing repo. And that coincides, by the way, with elevated SOFR interest rates or SOFR spreads. Now, here is another way to kind of look at it or visualize it. This is the standing repo minus the reverse repo. When this goes above zero, we're looking at the inverse of what we were looking at before. When this goes above zero, that means that the standing repo, the amount of cash being requested from the Fed is more than the inverse. And of course, we can see that that coincided again with the repo rate crisis back in September of 2019. We are seeing a similar dynamic. Now, remember, TradingView only shows the Wednesday level, but as we could see back on the Fed chart, which I will link in the description, it has been happening multiple days over the past week or two. And of course, that coincides with SOFR minus the reverse repo. Again, looking at a difference or delta, a spread between two interest rates, SOFR is moving higher relative to the reverse repo, which again is the red line in this chart. Remember, the Fed uses a couple interest rates, static interest rates, to try to set a corridor. They don't actually set one interest rate, they set multiple interest rates. We can see the discount window rate, that is the Fed going, no matter how scarce dollars get in the system, we will always provide them to you. We will always sell them at 4.25. The reverse repo is the exact opposite. That is saying, the Fed saying, no matter how overabundant dollars get, we will always buy them at 4% is the current interest rate. And of course, we can see that SOFR relative to this red line, relative to that floor that the Fed is trying to set in terms of interest rates, SOFR has been moving up over the past couple months. Again, indicating that we might be moving from an abundant liquidity regime into one of liquidity shortage. And again, it's not only SOFR, it's not only the secured market, it is also the Fed funds, which is unsecured. We can see that spread as well starting to move higher. And again, in pink, we have the standing repo facility. And again, it's only a Wednesday level. It does not update in TradingView every single day. So we only get kind of a weekly glance if the standing repo was tapped on that particular Wednesday. But again, as we could see from the Fed chart, it is getting tapped to an increasing degree over the past couple weeks. Again, indicating that the financial institutions need cash. They might have abundant treasuries, mortgage-backed securities. They might have abundant collateral, but they have a shortage of cash. Therefore, they are going to the Fed and requesting cash because they need actual dollar liquidity. Again, this is the same dynamic that we saw back in 2019 during the repo rate crisis. Now, I want to also throw on SOFR minus Fed funds, and we can see that that is also starting to become elevated. This is another way of measuring the relative liquidity strain in SOFR. You can look at IORB, which again is interest on reserve balances. That is the green line. You can look at reverse repo. You can look at Fed funds. It all paints the exact same picture. And what I want to point out, of course, the Fed's been engaged in quantitative tightening. That is one of the reasons that we are in this kind of dollar liquidity shortage sort of situation. One of them is, of course, the Fed has been engaged in quantitative tightening, which is a negative shock for dollar liquidity. I want to point out that when we had the repo rate crisis, of course, back in 2019, what did the Fed do? They immediately increased their balance sheet. Remember what the Fed does in a shortage of liquidity. They print bank reserves out of thin air. And the way that they get those into the financial system is they go to the banks and say, hey, you have abundant US treasuries. Maybe you have abundant mortgage-backed securities. Here is some cash and give us those securities. Give us that collateral. So by making that asset swap, they are injecting cash into the system. And of course, we can see the Fed balance sheet immediately following the repo rate crisis went from about 3.7 trillion all the way up to a peak of about 4.2 trillion. So what that means is the Fed printed about 500 billion in bank reserves and injected that into the system because, again, there was a shortage of dollar liquidity. And again, we all know what happened just a few months later. We can see the Fed balance sheet went vertical all the way up to 7.2 trillion. So very likely, if there is a repo rate spike, if SOFR starts to really dislocate, that is exactly what they will do. You might see some volatility in the equity markets. You might see some volatility, maybe in bonds, but it would be very, very short lived. This is a risk only really for the financial system. It wouldn't necessarily affect the average American. Now, the average American cannot go lend or borrow in overnight markets. So this is really a story about the financial system, about the financial plumbing, more so than it is one that could affect everyday Americans. But it is important because, again, when the Fed intervenes to correct a shortage of liquidity, what they are doing is they are printing bank reserves and injecting that into the system by buying assets from the banks. And remember, the Fed, when they create those bank reserves, they are just printing it out of thin air. And again, I just want to remind people that even though TradingView doesn't show the full picture, the standing repo facility is getting tapped to an increasingly frequent degree, indicating again that there is a shortage of dollar liquidity in the system. We can see that the SOFR minus reverse repo, and remember, the reverse repo is the floor in terms of what the Fed is trying to set for the price of money or the interest rate on an overnight dollar loan. The relative spread between SOFR and that reverse repo has been trending up. There's a lot of intraday volatility, but if you take a 10-day, 15-day, 20-day moving average, it is abundantly clear what is going on. And by the way, it is not month end or quarter end. Now we are approaching the end of October, but in general, you generally only see elevated SOFR spreads at the end of the month or the end of the quarter. And again, recently, over the past couple of weeks, we did have tax deadline here in mid-September, but recently we have not really had any normal cases or causes for there to be elevated liquidity strain. So this is clearly something that is independent from the normal kind of window dressing that you see at the end of the month or the end of the quarter. And again, the Fed's answer is going to be to print dollars out of thin air in the form of bank reserves, and then to inject those into the financial system by buying collateral, by buying U.S. Treasuries or mortgage-backed securities. In fact, you can go to this link. It'll be in the description. You can see in the standing repo, you can see what type of asset is being pledged as collateral. We can see a big spike there in mortgage-backed securities being pledged, $6 billion back on October 16th. But then you can also look at treasuries, and you can play around with this and watch this on a day-to-day sort of basis. And again, I also want to note that here are the SOFR percentiles. So this is, if you go to the Fed's website and look at the SOFR rates, they actually provide different percentiles. What we were looking at was the volume-weighted median, but this is actually the full data, and I decided to make some charts in case anyone was interested in that. But anyways, hopefully that was helpful. Remember, the answer to a shortage of liquidity is injection of liquidity. And how do they inject that liquidity? They print bank reserves out of thin air, and then they inject it into the system by buying collateral, by buying mortgage-backed securities or U.S. Treasuries. So anyways, hopefully that was helpful. And of course, I will catch you on the next one.